Hey guys, Mandla here at FX Link, and welcome to our special market preparation video. Now we have about 10 to 15 minutes to get this done, and today we are going to talk about how to save your trading year using money management. And as you see, we have a lot to get done here. So without further ado, let's get to it. Hey guys, welcome back to this special video. Today we are going to talk about basically this topic is evolving around money management and how to manage your trading system. All right. In this video, I'm assuming that you have a consistently profitable trading system already. So this video is for those people who have a trading system that has positive expectancy. And in this video, I'll be going over positive expectancy and maximum allowable drawdown separately, right? And I'll be going over how to compound and maximize your profits and how to use a money management checklist to do so on a separate video, which I'll post next week. But on this one, we'll be going over positive expectancy. Get right. And as a side note, I'll be touching on the psychological effects on positive expectancy and maximum allowable drawdown that it has on us traders, and how we can avoid them as we progress through our trading journey. So what is positive expectancy? Well, positive expectancy is a mathematically proven probability that a trader will end up with profits, not losses, right? This is a proven probability, which means that you have data that proves within your backtesting that you will end up with profits over a series of trades in the long run, right? Because trading is a long game. You're in this for the long haul, right? Now, we need to understand two things about trading. You need to avoid psychological pits whenever dealing with positive expectancy. I've added side notes on this one. It says, the most crucial information we can ever get from a trading system is positive expectancy, right? And positive expectancy has a lot of variations within it, right? But however, if we don't have positive expectancy, or if we don't know about positive expectancy, a trading bias called shiny thing syndrome will have an effect on us, right? Because most traders fall into making psychological mistakes of system hopping. Has anybody done that? I know I did. Like in my past, I dabbled into many strategies until I found one consistent strategy, and I've been using it ever since. As I began to reflect and ask myself why did I hop into many systems, I began to realize that I fell into a bias called shiny thing syndrome. Whatever shiny thing I see that is promising me a pot of gold, we tend to move towards it, right? As any human being does, we have a natural inclination to move from intense pain towards intense pleasure. Now, by system hopping, I mean that we are too quick to jump ship and go try out another system that makes or promises a few extra percentage a year. Now, there are a lot of biases that work against us and make us make dumb decisions. Like I said, the first one is shiny thing syndrome, right? And another one is the most powerful bias that Charlie Munger talks about is the reward bias. We tend to move towards pleasure. So whatever we are promised or whatever we are lured to, mostly it's either pain or reward. So whenever we get to a system, a concrete system, as traders, what tends to happen is that whenever we go through a period of drawdown, we try to avoid so much pain, and that's when second thoughts come in. And those second thoughts come in and tell us to do what? Seek another reward. Seek another system that promises to make an extra percentage or an extra point. Even if it's a little bit more than yours, we tend to fall for the mistake of trying to buy that system. By then, what we end up doing, we get half pregnant on each and every system, and we end up losing money. So we need to avoid this in order for us to save our trading year. So by this point, I assume that we already have a backtested system that is proven to be profitable. If you don't know how to calculate your positive expectancy, I'll show you how. The equation goes like this. It goes like this: 1 plus open bracket average win divided by average loss close bracket times percentage profitable minus 1, right? Then say that okay, I have my trading strategy, okay, and I have back tested my trading strategy, and I found that my average win is $200 on average, okay, and my average loss is $100, and the number of times I win versus the number of times I lose is 50%. Okay, now that I see, okay, I have a 50% trading strategy, and I have a win to loss ratio of 50%. Now in this case, in order for us to identify positive expectancy, let's calculate, will you? We would have to say, okay, let me bring in my calculator in order for this to be visible. Let's work out our win to loss ratio first. We would have to say, okay, $200, which is our average win, divided by our average loss, which is $100, which gives us 2. Okay, then it's 1 plus 2, which gives us 3. Okay, 3 times 0.5, which is our percent profitable, okay, which gives us 1.5 minus 1, it gives us $0.5 on a series of trades, which means that our trading strategy specifically gives us 50 cents, throughout a series of trades over time, and which is not bad. It's actually a good strategy that gives us 50 cents over time, because we can rely on having profit at the end of the day. A negative expectancy isn't accepted whenever you want to trade into the forex market, right? Because you can never apply money management in order for you to win. Okay, now that you have calculated your positive expectancy, what's left for you is, actually that's not what's left, but you can now progress on knowing the top 3 things to do with your maximum allowable drawdown. You can set your maximum allowable drawdown, and you would figure out that psychologically you are much more aware, and when you become aware, you are most likely to be at that conscious competence stage, which is ultimately where we want to surpass in order for us to be good at trading and end up being at an unconscious competence stage, right? Now, 3 things we need to things to do, actually. These are my top 3 things I actually think that is beneficial to most traders to know about maximum allowable drawdown. First, maximum allowable drawdown is a limit that you set for yourself after seeing your losing streak on your backtesting. Say that you lose seven trades, you have lost 7 trades in a row. This means that throughout your backtesting, you've discovered that your system has the ability to lose 7 trades in a row. Okay, and in order for us to protect ourselves throughout those 7 trades in a row, we need to set our maximum allowable drawdown, which is a percentage, saying that, okay, now that I have a $10,000 account, okay, which is our starting balance, and we have a maximum drawdown of 200 pips, which we got on our backtesting. Say that those 7 trades amount to 200 pips, and we are trading 5 pairs, and you come to a conclusion that psychologically I cannot bear the thought of losing more than 20% of my starting balance, of my capital. What you would do is you would set your maximum allowable drawdown, okay, and you would play around that maximum allowable drawdown to make sure that whatever you trade, whatever trade that is open at once throughout those 5 pairs that you are trading, you are less likely to be way above your maximum allowable drawdown. Now, first step, you need to stay within your risk management boundaries, which is setting your maximum allowable drawdown. And the second step is you need to set a per trade limit. In order for you to do that, you ask yourself now, okay, Mandla, now that you've set your MAD, what is a per trade limit for me on each and every trade? Well, we take that $10,000 account starting balance, we times it by 20% to have a figure for our maximum allowable drawdown, which is our $2,000. Now that we have our $2,000, we know that this $2,000, we shouldn't exceed that. So in order for us to do that, we take our maximum drawdown, our losing streak, in pips, and divide it in our $2,000, which is our maximum allowable drawdown, which would give us $10 per pip. Okay, and we take that $10 divided by 5 pairs, which gives us a $2 per pip. So in each and every trade that we place on our 5 pairs, we cannot exceed our $2 risk, assuming that all of those 5 pairs will be opened at once. Okay, we are preparing ourselves for the future, as we cannot know whether 2 or 3 pairs or 5 pairs can be opened at once. So in order for us to stay alert, we account for all of these pairs. And the next step is to mentally asset yourself for a stream of losses incurred in backtesting. This is surprisingly hard, right? Because when you jump off backtesting and go to live trading, I remember I had an experience like that. When I jumped off backtesting and went to live trading, it was a totally different environment, because I knew for a fact that my strategy has an ability to lose 7 trades in a row, and my maximum allowable drawdown at that time, drawdown is 274 pips. However, my mind started to play games on me, right? First week, you lose 2 trades. You say, okay, I can fight the next week. I need to relax, because you haven't went out your stream of losses yet, right? Then the next week comes, and I lose another 2 or 3 trades. Instead of me relaxing, I usually tend to look at the dollar amounts of whether I was losing or winning at that trade. If I would win a little bit, I would tend to cut my wins short, and and be reckless on my risks. And what I would do is I would lose 7 trades in the row, and I'll start to fall for psychological effects that are negative for the brain in trading. Actually, I would start to be afraid of taking the next trade. Okay, and after being afraid of taking the next trade, I would see, oh, this was a winner. Okay, then enter into another trade, and unfortunately it becomes another loser. And I would say, oh, I've gone past my maximum allowable drawdown, so I need to sit down and retweak my strategy over and over and over and over and over again, not realizing that psychologically I'm making mistakes. Okay, so these are the things that you need to take guard of whenever you are trading live. Okay, and you need to understand the psychology behind your maximum allowable drawdown. You would be much less prone to fall for the Gamblers Fallacy. By Gamblers Fallacy, going back to that example that I explained back then, I used to go through 7 trades, right? And I would hope that this trade that I'm trading, this must be the one, all right? This must be the winner. And it doesn't. It doesn't. Actually, when you place a trade, you must expect a loser automatically. And this is counterintuitive because everybody doesn't like to lose. But in this trading, you must expect losers to come. All right? And our third one is you would be less prone to the lotto bias, which is we are naturally inclined to feel the sense of control of our environment. So we want to feel the sense of control of our environment, even if we aren't controlling. Most of the times it's an illusion. Free will is an illusion most of the time, right? This might start off another debate, so I would not touch base on this free will stuff. But the lotto bias. Think of people who go to the lotto stand. What do? They feel some sense of control because they picked the numbers. And at first, the lotto would choose random numbers for you, and you would lose. But they figured that, oh, these people we aren't having much customers, and we are losing money. So they thought, somebody came with a brilliant idea and say, why don't these people choose for themselves? Give them some feeling that they are in control of the market. And we like to feel, same goes with the market, right? Shiny thing syndrome, hopping into another system, right? Because of, again, going back to the same mistake I used to do. I would skip trades that I want to place, that I should place, and I would fall for losing trades, and I would blame my system for that instead of my psychological processes, my mind, instead of me. Okay, most of us, when we open our trade, say that this is a good day. You wake up in the morning, do your technical analysis, and you feel good. You feel good about your day. A New York session is about to open. You see a setup. You place your trade. Okay, a couple of hours later, you see that your trade is near. Okay, a couple of pips near your take profits, right? And you have gone through a couple of losing periods, right? And understanding that we have a natural inclination to move from intense pain towards intense reward, what do? We say, 5 pips, let me shave off that 5 pips and take those profits right there, right? And that 5 pips begins to grow larger and larger and larger as you keep on taking profits too early. And worst thing, actually it's worse, because some traders, what they do is they leave room for their stop losses, because what the market tends to do is that it would stop them out and then go to their direction, and they'll be like, oh, I shoulda, coulda, woulda, I should have put my stop losses 10 pips below. And the next time, what do they do? Put their stop losses 10 pips below. And this gives us, I used to do this. I used to do a lot of mistakes actually in my past, and I ended up having a risk to reward which doesn't make sense. Totally doesn't make sense. And I understand. So knowing this type of information might help